Hello and welcome back. And today we're going to talk about the take profit. But before we continue, I'd like to ask you to please leave a review for this course. It's very simple to leave a review. If you're on the main page of the course, all you have to do is click this link up at the top with the star which says write a review, and then select the number of stars you think the course deserves, and maybe write a short message with some feedback for me. I know we're not finished with the course yet, but I would really appreciate if you could leave a review based on the materials you have already seen. It would assist other students who have not yet signed up for the course in understanding whether the course is worth their while or not. And also it would really help me out, and I would really appreciate it. So if you could do that for me, that would be just fantastic. And now let's move on with our course. So, the take profit. Let's imagine that we have some sort of market movement, which is illustrated by this line chart on the left. And also, let's assume that your analysis at this point in time suggests that we should enter into a buy order. And that's exactly what we do. Well, a take profit is an additional order which you can make part of your buy order. So basically you can make this alteration to your buy order, specifying that if the price ever reaches a certain level, then you want your buy order to automatically be closed. So you can always close any order manually with just by clicking on it and telling the trading terminal to close the order. But in this case, you are embedding a condition in your buy order, which is called a take profit. And this condition will check whether or not the price is at or above a certain level, which is marked here with the red line. And as soon as the price is at that level or above it, then the order will be automatically closed. So let's have a look at an example. Let's assume the market kept moving from where we entered, went up, then went a bit down, and then shot up straight through the take profit level. The green cross here marks where the order would have been closed, so you wouldn't have to do anything at all. It would happen automatically. Therefore, you would earn a profit from this order closing, and that's why this is called a take profit. Now, for a sell order, we have a similar situation. Let's assume this is the market line chart, and then our analysis tells us to enter into a sell order, which we successfully do. Well, we can also embed a take profit in the sell order. As you would imagine, the take profit for a sell order has to be below the entry point, because we will earn profit if the market goes down. We're taking a short position in the market. So let's see what happens next. The market goes against us for a bit, then goes in our favor, then kind of flattens out a bit, and then it goes straight through the take profit. And that's where our order gets closed, and we earn profit on the Forex market. That's why it's also called a take profit. So that was our take profit. Don't forget to leave a review for this course if you haven't yet. And until next time, happy trading. Equity and margin. In the previous tutorial, we explored an example where we were opening a hypothetical order of 0.1 lots. Now, to create this transaction, we required $12,322. And because that was quite a substantial amount, we explored the concept of leverage. And in fact, we found that with a leverage of 1 to 100, we could borrow 99% of the required amount from the broker, and we would only be required to put in 1% or $123. Now that amount that we need to put in, the $123, is called the margin for this transaction. And today we're going to talk more about the margin and find out exactly why the broker is willing to lend us 99% and how leverage works in the background and how all these concepts play out when you open an order and when the market goes against you and when the market goes in your favor. So let's jump straight into it. So here is our $500 balance, and now we want to open that transaction which we talked about. So the broker puts in $12,199, we put in $123, the $123 is our margin, and the remaining funds, so the 500 minus the 123, the $377, that is called the free margin. Now, here we're going to introduce one more concept, and that is the concept of equity. Now, normally equity is defined as the balance on your account plus or minus any unrealized profit or loss. So basically, your balance is constant until you actually close your transaction, but your equity reflects whether the market is going in your favor or it's going against you. However, in this example, to start off with, we're going to kind of introduce equity backwards. We're going to introduce equity as the free margin on your account plus the margin. There's no big difference, and you'll see just in a few moments how that is exactly the same as what we discussed about balance and unrealized profit or loss. So there's our equity. We're going to outline it with a green bracket here on the right. And now let's see what happens as the market moves in either direction. So we'll start off with by looking at what happens when the market moves against us. So if the market moves against our position, then first of all, let's say it moves against us, and the unrealized loss on our account is $100. So as you can see, the margin is intact, the broker funds are intact, but the free margin has reduced by $100. And therefore, our equity has also reduced by $100. At the same time, we should note that the balance hasn't changed. So that big box, the overall box is still $500, and still it looks like we have $500 on our account because that's our balance. But in reality, there is an unrealized loss, and it's called an unrealized loss because you haven't yet closed the transaction. So that loss might change into a profit with time, or it might increase as a loss. So if the market keeps going against us, now the free margin has reduced by $200 and the equity has reduced by $200. And at the same time, the borrowed funds and the margin, the frozen margin, are still intact. Now, what happens if the market keeps going against us? Well, what will happen is a stop out. So a stop out is when the broker sees that you have lost quite a lot of funds and you don't have any free margin left, and in that case the broker will automatically close your position, and this loss will become a realized loss, and that way they will be able to pull out of this position. So because they lent you some money, now they see that the position has gone against you, they don't want to lose any of the money that they lent you, so they're just going to close your position and pull out their $12,199. And in this case, the margin acts as a safety net or a safety buffer. So basically the broker is saying, okay, this trader doesn't have any free margin left, we should close the position, and in that case, what will happen is they pull back the $12,199 and you get back your margin. So your margin is returned to you. So why does the broker use this margin as a safety buffer? Well, because while they're closing the transaction, the market can actually move, and they might not have enough time to close the transaction spot on that margin level. So the market might even move a bit further against you and might eat into your margin, and you won't get $123, you might get $100 back, or $90 back, or even $50 back. So that is their safety buffer. So that is the funds that will get eaten into before the funds that they actually lent you. So that's how the broker uses the margin as a safety net. And as you can see, the equity has also reduced to the size of the margin. Now, the stop out can happen at when all of your free margin is eaten up, so when you only have margin left, or maybe when you have half of your margin left. So the broker might, in its terms and conditions, specify that it will allow 50% of the margin to be used up before the stop out occurs, or it might allow 70% of the margin to be used up. So you have to refer to the terms and conditions of your broker to understand at which point a stop out will occur. And another thing you should be aware of is that sometimes there will also be a margin call. So a margin call normally occurs before a stop out, and it's a warning from the broker telling you that you're getting very close to the stop out level and you should intervene and do something about it. Now, it's not necessarily going to happen. You're not necessarily going to have a margin call, and in fact, a lot of brokers might have the margin call set at the same level as the stop out. So basically the margin call won't happen because it's too late anyway. The stop out has occurred. So that's another thing you should look into and check with your broker, check in the terms and conditions or the product disclosure statement, and find out Is there a margin call? When does it occur? What levels do the stop outs occur at? Okay, so that's what happens if the position goes against you. Now let's see what happens if the position goes in your favor. Back to the start, here we've got our equity on the right, free margin and margin, and let's say you have set a take profit somewhere up at the top over there where the dashed or the dotted line is. Now, if the position moves in your favor, so here we can see that we've earned some money. As you can see, your position still isn't closed, so your balance is still $500, but your free margin has increased. So any unrealized profit or loss is being added to your free margin. And therefore, as you can see, your equity is increasing. And that's a good thing because now you can use this free margin to open more transactions if you wish to do so. But we're not going to go into that. Let's continue with this example. So your free margin is increasing, your equity is increasing, and the market keeps moving in your favor, and it hits your take profit. Hooray! Your free margin has increased, your equity has increased. At the same time, you can see that the margin is still the same, still $123, and the amount of money that you borrowed from the broker hasn't changed. It's still $12,199. So what happens next is your position closes. The broker pulls back their amount, so they take back their $12,199, and your margin is released and it is added to back to your account. So it was always on your account, but now it's released and it's no longer a frozen margin. So now your balance is $773. So as you can see here, that is one of the great advantages of leverage, is that the broker just at the end, when the transaction is complete, all the broker wants back is the money it lent you. They don't want, they're not going to penalize you for using leverage, and therefore you get to keep all of the profits you made. So even though you borrowed money to open this transaction, you get to keep all the profits you make. The downside, of course, is that any losses you make are also you're going to be liable for any of those losses that you make. So there we go. That's how leverage works. And in a way, it's kind of like a magnifying glass. Without leverage, you can only conduct, if you even have enough balance to conduct the smallest amount transactions on, like micro transactions on the Forex. With leverage, everything is magnified. So you can conduct greater transactions, you incur greater profits, and at the same time you will incur greater losses if they occur, and you only have that amount of money that is on your account to accommodate those losses. So as soon as your money runs out, as soon as your free margin runs out, the broker will pull their funds back. So in a way, I like to think of leverage as a sports car. So of course you can hurt yourself by driving a sports car, but if you know what you're doing and if you're careful about it and you're just driving it safely, then you can derive substantial benefits from it. And same thing with leverage. Of course, you can hurt yourself and there are substantial risks associated with leverage. But on the other hand, if you know what you're doing, if you calculate your risks, and if you're careful about it, then you can derive substantial benefits from having that leverage. All right, so that's how leverage works. And before we conclude this tutorial, I would like to highlight one more important key risk associated with leverage. So I'm going to go back to our example here, and let's go back to the example where the market goes against us. So here you can see that there's a stop out, which kind of is a safety net for the broker, and after the stop out happens, you get your margin back, the broker gets the amount that it lent you back, and that's the end of it. However, sometimes it so happens on the Forex market that the movement that caused your position to go against you, that can be so quick and so volatile, so like it can be such a big movement that the broker might not have enough time or might not have an opportunity, there might not be a price in the market for your position to be closed at the stop out. So the broker is intending to close it, but it's just not able to do it. So in that case, as we discussed, your margin will start to suffer, and the funds will be, any additional losses will be taken out of your margin. And that way, your margin is like this little safety buffer between your funds, your free margin, and the broker's funds, the ones that they lent you. But at the same time, if that market movement is so drastic and so quick that it actually chews up through all of your margin, then what will happen is that before the broker is able to close the position, the broker's funds will start to suffer. So the market will start eating into the 12,199 that the broker lent you in this specific example. And that is an additional risk. So if the market moves so quickly that it eats up all of your margin and it uses up some or even all of the money that the broker lent you, then you should be aware that you will be liable for those funds that were used up from the amounts that the broker lent you. So you need to check the terms and conditions, but there's a very high chance that you will be liable for those funds, and the broker can reclaim them back from you. So the broker can ask you to pay back that money. So be careful with that. That is an inherent risk of using leverage. And of course, this risk is has to be verified with your broker, has to be checked with your terms and conditions, but you should make yourself aware of that, and you should understand this risk when you're using leverage. So I just wanted to make sure that you're aware of that. And that brings us to the end of today's tutorial. There we go, talked about equity and margin, and hopefully now you have a very clear understanding of how leverage works and why exactly brokers are willing to lend you that money. Okay, I look forward to seeing you on the next tutorial, and until then, happy trading. Types of orders on the Forex market. There are two main classes of orders on the Forex market, and these are market orders and pending orders. And there are two categories in the pending orders. These are stop orders and limit orders, and we'll have a look at all of them right now. So market orders, you're already familiar with these orders. These are the buy order and the sell order. Stop orders. So the first type of stop order that I'd like to introduce you to is the buy stop. So basically the buy stop is a pending type of order. What that means is that when you set a buy stop, you're not actually entering the market, you're setting a condition or a trigger or a future order. So you're saying, if something were to happen, then I want my terminal to enter the market automatically for me. So basically what this, in this case, what's happening is you're saying that if the price reaches this green line, I want to enter the market with a buy order. So let's see how that happens. The price crosses the green line, and that's exactly when your buy stop order turns into a buy order. So from that red cross onwards, your buy stop order no longer exists. Now you have a buy order in the market. Sell stop order, very similar. So you're saying when the price crosses the green line, I want to enter the market with a sell order. See, when that happens, your sell stop order turns into a sell order instantly. So what's the benefit of these buy stop and sell stop orders? Well, it's basically kind of saving you the effort of actually waiting for the price to get to that level and then entering the market. So if you think that once the price crosses a certain a certain price level or support line, you think the price will keep going downwards, that's when you would want to set a sell stop order and catch that movement as soon as it starts, rather than having to sit around and wait for it to happen. The other thing is that if that doesn't happen, if the price, for example, in this image that we have in front of us, if the price were to keep going upwards, then you would never enter the market at a sell with a sell order, because the price wouldn't have crossed this green line and wouldn't have triggered the sell order. So it's kind of a very convenient way to save your time and also check for specific conditions that you're looking for. Limit orders. Limit orders are similar to stop orders, but they may be a little bit more complicated to remember how they work, but we'll get the hang of it. So a buy limit order is actually set below the market. So what you're anticipating is for the market to go down, touch your order, cross it, touch it, and then go back up. So you're kind of anticipating a recoil. You think that yes, the market will go up, but first it will go down. And instead of entering right away, so you could have entered back here with a buy order, you want to get the most of this movement. So you want to actually let the market go down a bit, then enter with a buy order, and then you'll get this whole movement rather than getting only half of it. Once the red cross happens over here, your buy limit is no longer a buy limit order. It transforms automatically into a buy order, and you enter the market. That's the point when you enter the market, when the transaction occurs, the opening of the order. Sell limit, it's a very similar concept. You are anticipating an upward movement before a downward movement. So you think that the price will go up, it'll touch your sell limit order, trigger it, and then go down. Once again, you would do this if you're anticipating an overall downward trend, but you think there will first be some sort of retracement upwards. And instead of entering the market back over here with a sell order, you want to get the full movement, so you let the market go up first, touch your sell limit order, and then go down. So in this case, even if the market price crosses your sell limit order, it will still be triggered as a sell order. So there's always these risks that the market will trigger your sell limit order, turn it into a sell order, and then keep going upwards. That can also happen, and your sell limit order will be triggered and you will be in the market. And that's why you should still use stop loss and take profits with your limit and stop order. So even with a sell limit order, for example, you can tell it to set a stop loss and take profit. Of course, the stop loss would have to be above, take profit would have to be below, and it works exactly the same way, because remember, once the order is triggered, it will either turn into a buy order or a sell order, and all the same rules apply as before. So with your pending orders, you can also set stop loss and take profit levels, which will be triggered with the order, meaning that as soon as the order turns into a buy or sell order, the take profit and stop loss levels will be activated, and they will be protecting your order as they would with any other market order. And to sum up, we've got our different order classes, different order types, and anticipated market movements. So the first two are the market orders. They're the buy and the sell. For buy, we would enter into a buy when we anticipate an upward movement, into a sell when we anticipate a downward trend. And then for pending orders, we would open a buy stop order when we think the market will go up, and then it will continue going up. So we kind of want to check this condition that the market will cross some sort of resistance line, and if that happens, then only we want our buy stop order to become a buy order. Sell stop, similar, we expect the market to go down and then keep going down. Buy limit, we expect the market to go down first a little bit and then go up. And sell limit, we expect the market to go up and then go down. So that's the summary for order types. Don't forget to leave a review for this course if you haven't yet. I would really appreciate that, and I look forward to seeing you in the next tutorial. Until then, happy trading. Stop loss. The concept of a stop loss is very similar to a take profit, but it is the other way around. It's the opposite, actually. So this is our market movement. We enter into a buy order, and we can embed a stop loss with our buy order. So it's an additional order in the Forex market, but it is linked to our buy order. So basically what it means is, if the price was ever to go and reach this red level or go below it, then the buy order has to be automatically closed. So that kind of saves you the trouble of monitoring the market and always worrying and checking if the price has gone down, because you put this rule into your buy order, and as soon as this condition is met, your buy order will be closed. So this is the market going down against us. So we were thinking it was going to go up, but actually went down, and then bam, price crosses our stop loss and the order gets closed. Of course, this yields a certain loss on our account. So at this stage you would ask, why is a stop loss good and if it brings losses? Well, let's see what happens to the market further down the track. It goes a bit up, it goes down, it goes up, and then it goes further down. So as you can see, there could have been potentially a much higher loss. Say this one, or even this one. So, or even more than that. And so it's better to control your losses and exit according to your trading strategy, and exit on time rather than overweight and bear a very high loss. So smaller losses are much better than bigger losses, and that's where your stop loss comes into play. It helps you exit the market, because what we're doing in trading is we won't always win in all of our trades. There will be losses. Inevitably, there will be losses on the account. And it's all about managing those losses, managing those risks, and getting out of the market on time. And that's where your stop loss will help you control the losses on your account. It's a very important feature, and I highly recommend to always set a stop loss for any of your orders. Let's look at a stop loss for a sell order. So a sell order, we're anticipating a downward movement in the market. We can set a stop loss which has to be above the entry price, and that's because when we anticipate a downward movement, we will only lose if there's an upward movement. So let's see what happens in the market. The price goes a bit against us and goes kind of in our favor, but then it crosses our stop loss, and unfortunately there's a small loss on the account. Let's see what happened to the price going forward. Went up, went even further up. So if not for our stop loss, we could have closed the order there, or we could have even closed it there, and that would have been a much, much greater loss on the account. So as you can see, stop losses, even though they bring losses to the account, but they are very, very useful and very helpful in controlling your risks and managing any potential losses on the account. And so just a final note to finish off, take profits and stop loss can and probably should be set together. As I said, I recommend always setting a stop loss, and you can combine it with a take profit if you like. You can set both of them and attach them to one order. Finally, a word of caution. Sometimes when the market volatility is very, very high, for example, during in market news, your broker may not be able to execute your stop loss. It is a very rare condition, but sometimes happens when there's just basically no price, no takers at your stop loss level or take profit level. And what will happen then is a massive slippage can happen, and even though you have a stop loss, it's not 100% guarantee that your order will be closed at stop loss. It's probably like a 90-95% guarantee, but sometimes it does happen that an order can slip through. That's an inherent risk of the Forex market. You have to be aware of that, and that's why I highly recommend having a look at my tutorials on fundamental trading and seeing how to kind of understand when there's market movements, so you avoid trading at those times. That's what I personally do. I kind of stay out of the market when I know there's going to be massive movement.